Welcome to America's Commercial Real Estate Show, your source for market intelligence, forecasts, and success strategies. Hello, I'm Michael Bull. Thanks for joining us on one of the radio stations, iTunes, YouTube, or the show website. We appreciate you being with us. We have a great show for you today. We're going to talk about the office market, the office sector, the fundamentals, an update, a forecast. What do we expect to moving forward? And if your company uses office space, or you are a real estate investor, or you work with those who use office space or invest in space, then you want to hear this show. Please welcome my first guest. It's Jim Costello. He's Senior Vice President with RC Analytics, joining us on Skype. Jim, thanks for being with us.
Thanks for having me here.
Well, Jim, so you guys do a great job of tracking investment sales for all property types, and I think people are kind of curious about office investment sales. Seems to be a little bit of flux in the marketplace. What are you guys seeing?
Yeah, we're just in the middle of releasing our first quarter figures here today. Deal volume for the office sector fell 12% on a year-over-year basis in the first quarter. That's got a lot of folks worried. We've had a steady downbeat of falling volume on a year-over-year basis for more than a year now. And a lot of folks look at that and they think, hey, deal volume's falling, so prices are the next thing to fall, just like in 08, 09. But even though they see that and think that might happen, prices have been sticky. We haven't seen a big decline yet. And one of the lessons from that is every cycle has some things that rhyme, but there's different drivers every time. So you can't always use the past as a perfect predictor of the future.
So how sticky are the prices?
And cap rates, even after the election, interest rates moved up, and cap rates have largely held constant. In CBD offices and the 6 major metros, these are the areas that have been getting so much attention from global investors. You're still down in the 5%, but just around 5%. Really, there's only one area that's shown any kind of adjustment in cap rates. That's suburban assets within the 6 major markets of the United States. And that's going to be your Boston, New York, D.C., L.A., San Francisco, Chicago. But I think that upward creep is, and it's on the order of around 50 basis points since the election. Since it only happened in one subtype, I don't think it has anything to do with the locations and the asset classes.
So suburban cap rates are doing what? They're going up or down 50 basis points?
They've gone up.
Gone up.
It's the increase there is not really about the interest rate environment. It's an issue of the types of things that are selling.
I see.
If you're in those locations and you have some strength again in the leasing market after it had been weak for a while, when early in this recovery, all the demand was in the CBDs, and if you've got some leasing going on again and you've got a great asset in that location, why sell now if you don't have to? And I think there's an adverse selection issue in terms of what's coming to the market at the moment that's driving up cap rates in just those suburban areas. Other suburban areas aren't seeing that. Outside of those 6 major metros, cap rates for suburban assets are flat to decreasing.
I see. Yeah, don't sell if you hate to ever have to sell, right?
Right.
But
right.
Some people are thinking maybe you take a few chips off the table right now because we're in an environment that you expect interest rates to rise. So what do you expect moving forward for interest rates and cap rates?
Well, interest rates have gone up, and the question that a lot of folks are struggling with is how much more will they go up? There's a lot of uncertainty out there on fiscal policy, monetary policy, and regulatory policy. That combination, I think, is also impacting deal volume. It's hard to place capital. It's hard to make a decision when you don't know what the rules of the game are going to be. And I think that's weighing on investors as well. But if interest rates do go up a bit more, the first 100 basis points of increase in cap rate of interest rates, we thought that the spread between cap rates and interest rates would absorb that. If you really start to go beyond that point, I think cap rates will have to go up a bit more. But that doesn't mean that it's a one-to-one movement. that spread between them is never a constant. That spread embeds a whole set of expectations on growth in the economy, expectations on risk tolerance on the part of investors. If we do see further interest rate increases, it's coming about not just because the Fed is raising rates and because that interest rates go up. If they really do go up, it's going to be because there's growth in the economy, there's investment, there's competition for capital, and that in turn will make the income streams from the tenants and office buildings look more secure to investors. So as interest rates go up, you won't have a one-to-one increase in cap rates. I don't know precisely how much, but it's something that as interest rates go up, I wouldn't expect the same kind of increase in cap rates.
Yeah, well, that's interesting. But I guess because buyers are always beating on brokers when they don't like our list prices. But we're certainly already hearing, hey, our cost of capital is going up. If we accept this, we're hoping for the same yield. So we're going to have to adjust our prices. So it'll be interesting to see what happens moving forward. But from what I'm hearing, we're going to see 2, maybe 3 rate hikes each year for the next couple of years. And so I think it's interesting to see. Well, if you thinking about taking some chips off the table today, and you think you can absorb 100 basis points rate increase, was that from when rates started rising or from today?
From when rates started rising. So we've already got, it depends on what day it is, whether the market is optimistic or pessimistic. In the last couple days, we've seen a fall in the 10-year Treasury. It could easily go back the other direction. But on average, we had seen sort of a max move so far of around 90 basis points for the 10-year Treasury. If it goes further, then that might start eating into cap rates, unless those sellers continue to be sticky. I mean, you noted that buyers are coming to you and saying, "Hey, I need an adjustment because my cost of capital is changing and my return expectations." Sellers, if they don't have to sell, why should they? If they're stuck in a situation where they've got a cash flowing asset that's giving them a good return, if someone's not going to meet their price expectations, I think really why should they move? And that's where I think the real challenge is going to be moving ahead. I'm not sure that cap rates will bear the price of adjustment to higher interest rates. I think deal volume will. Yeah. I think it's just going to be a harder market to bring buyers and sellers together right now.
Yeah, especially if the fundamentals keep improving and the outlook for jobs is strong. We're talking with Jim Costello, Senior VP with RC Analytics, about the investment market, and we're talking about the office market in particular today. So Jim, you guys study the numbers. Where are the opportunities? Are the opportunities in B, suburban? Are the opportunities in maybe some smaller markets? Where should people look today?
The thing that we've seen in the last year in terms of where people have been chasing opportunities is trying to move a little bit away from the highly priced 6 major markets, especially the CBD locations. Those areas are hyper competitive. Prices have been driven to record highs, so much so that new construction has been justifiable in some cases. Where deal volume has been stronger, it has been more in the secondary markets. The thing I've been surprised by, I figured, if you're hungry for yield, if you want to take on a little bit more return, you got to take on some risk. And there's 2 ways you could do that. You could take investment style, a type of risk, moving from more core assets to more value add and opportunistic, or move out on that geography continuum. So far, it seems like investors, in terms of where the deal volume has been, it's been more focused on just buying core assets in secondary markets. It's been much less so in the last 12 months, looking at more value-add and opportunistic type investments. That just hasn't grown the same degree as moving out on the geography risk spectrum.
Yeah. Well, it's interesting. Our headquarters is in Atlanta, and there sure is strong demand in Atlanta, and I guess we're considered one of those second-tier markets, I guess, and we're having strong growth in our rent, so we're having strong growth in our values. So, Jim, we appreciate your time and your insight. Thanks for being with us today.
Thank you.
If you'd like more information from Jim and RC Analytics, we'll have their website at creshow.com. Stay tuned. We'll have more on the fundamentals and some other strategies for leasing space in the U.S. I'm Michael Bull. This is America's Commercial Real Estate Show.